So, welcome to my channel where I translate technical accounting lessons to a storytelling version, sort of. Now, as for today's story, let's go directly to it. As if you are Baby G and you bought a flying car, this car. So, because of that, you executed this document where you are to pay 1 million to be paid as follows. So, on 12/31/20 x 1, 300,000, and then on 12/31/20 x 2, you have 400,000, and on 12/31/20 x 3, you are to pay 300,000. Okay? However, aside from these payments, you are also to pay 10% based on the outstanding balance of your debt. Okay? So, the beginning debt balance in this given situation is 1 million. So, we need to multiply the 10% in that. So, 1 million times 10% equals 100,000. So, that's the interest that you are to pay on year 1. So, all in all, you have to pay 400,000. So, 300,000 for the principal and 100,000 for the interest. Okay? And then, at year 2, we have an outstanding balance of 700,000 only. Because, as you noticed, 300,000 out of the 1 million total debt has already been paid in year 1. So again, in the second year, 700,000 is the outstanding balance. Okay? So 700,000 times 10%, that's 70,000. So in year 2, you have to pay all in all 470,000. Again, 400,000 for the principal and 70,000 for the interest. Okay? And in the last year, the interest will already be based on the outstanding balance of 300,000. Because from 1 million minus 300,000 in this year 1 and minus this 400,000 payment in this year 2, so we only have 300,000 left as the outstanding balance at year 3. Okay? So 10% times 300,000, we have 30,000 as the interest in year 3. So all in all, you have to pay as Baby G 330,000. Okay? Now, there is a twist. And that twist is that you have an option in the very first place to buy this flying car in cash for 983,116. But let's assume that you have no cash in this moment. Okay? So again, since you don't have cash in that moment, you executed this promissory note to pay in installments. Now, what is the problem? The problem is, if you are to account your purchase and your liability with all of this information, including this cash option, cash purchase option, how will you do it? So, let's answer that after this. So, now, if these are all the given information, the initial entry will be very easy. It's just debit flying car and then credit notes payable. But the twist is you are to use the cash price of 983,116, even if you did not choose to purchase it for cash. Okay? So that's the twist in this problem in accounting. Now, the only problem is that you have to get a new effective rate because you cannot use this nominal rate of 10%. Because if you use this in getting the present value of these payments, like this 400,000 times 1.10 raised to the power of -1 plus the answer on 470,000 here times 1.10 raised to the power of -2 plus the answer on this 330,000 times 1.10 raised to the power of -3, the sum of those present value of these payments will be 1 million. And you can try checking on that on your own. Okay? Anyways, I am very sure that if you use this 10%, you will get a present value of 1 million for these payments. And that's not what we're looking for. What we're looking for is the interest rate that if you use it in getting the present value of these payments, you will get the cash price of 983,116. Okay? So, how do you get that rate? Of course, by trial and error and interpolation. And the next question is, how to do an interpolation? I have episodes about that, and their links are on the description below. So, before you continue with this video, watch those videos first. Okay? So, pause this video now and watch them first. Like right now. Pause it. Okay? And assuming that you did that already, pause this again and try solving for the effective rate for this illustrative problem. Okay? Pause it now. Again. And if you did that also already, then let me tell you that the effective rate for this illustrative problem is 11%. Now, let's prove. Let's start with the payments for years 1 to 3. And we have 400,000 for year 1, 470,000 for year 2, and 330,000 for year 3. Okay? And then each of these payments will be multiplied by 1 plus interest rate raised to the power of negative n, or number of periods. So, substituting, we have 400,000 times 1.11 raised to the power of negative 1, because this 400,000 will be due after 1 year already. Okay? While this here will be multiplied with 1.11 raised to the power of negative 2, because this 470,000 will be due after the second year. Okay? And lastly, we have 1.11 raised to the power of negative 3. Now, if we compute these 3, we will get these factors. And you're welcome to try and compute and check these factors on your own. Okay? Now, these factors times each of these payments or payments per year, and we will have these present values. Now, let's get the sum, and we will get the total present value of 983,114, which is very, very close to the cash price. Okay? So, we are going to conclude already that the effective rate is 11%, and it's fine even if there is a little bit of discrepancy. Okay? So now that we have already the initial value and we also have the effective rate of 11%, we can already complete this timeline. Now, it's time to complete this timeline. So first, let's plot the initial value at the beginning of the timeline. And then, let's multiply it with 1.11, or 1 plus effective rate that we have computed. And we will get 1,091,259. And then, minus 300,000, which is the first principal payment and the first interest payment of 100,000. And we will have a carrying value of 691,259 at the end of year 1. Okay? Now, times again 1.11. And we have 767,297 minus 400,000 principal and another minus 70,000 interest payment. And we will have 297,297, which is the carrying value at the end of year 2. Okay? And then for the last time, times 1.11 again equals 330,000, and minus the last principal of 300,000 and the last interest payment of 30,000, and we will have 0. So that's the completed timeline, which features the different valuation of your liability at different dates until it's fully paid. Okay? Now, how about the entries? Of course, if it's a liability, then you have to debit immediately interest expense. And for year 1, we have the difference of this 1,091,259 and this 983,116, which is 108,143. Okay? And another debit should be the notes payable, because the payable decreased from 983,116 to only 691,259. So the decrease, which is 291,857, should be debited to notes payable account. Okay? So those are the debits. And then of course, credit cash for the whole 400,000 for the whole principal and interest payment. So that's the complete entry, complete set of entry at the end of year 1. Okay? Now, for year 2 and year 3, we have a very similar entry. But the amounts are not the same, of course. So the interest expense for year 2 will be the difference of this after interest amount and this amount, the before interest amount. And the difference of these two, that's 76,038. That should be debited as the interest expense for year 2. And the debit notes payable will be the difference of these two balances. And the difference of these two, we have 393,962. So those are the debits at the end of year 2. And of course, we have credit cash for 470,000. Again, that is composed already of principal payment and interest payment. Okay? And for the last year, again, we have similar entry. So the interest expense amounts and the other amounts are the ones that are changed. So the interest expense for the last year is just the difference of these two. And the difference of that two is 32,703. Okay? So that's the interest expense. And the debit notes payable is just this 297,297 minus 0. So we have to put here, we have to debit 297,297. And of course, let's have a credit cash for the last principal and interest payment, which is 330,000. Okay? So that's how you record and measure your notes payable as Baby G in this illustrative problem. Okay? Now, it's time to end this video to keep this short. So in the next episode, let's talk about the other twists in this illustration and the summary of questions that might be asked of you and the accounting for notes receivable. Okay? So thank you for watching and see you on my next episode.